welcome to another episode of the Federal Church Presents Better Than Bloomberg, covering the global financial collapse 2023, the worst in history. Which is not an exaggeration, given how much money they're spending. It is the worst in history. What's amount? So there was a note here from Zero Hedge where it gives brings up a couple of topics that are good to be talking about there. Were the bank bailouts the result of rising wealth concentration? No. Bank bailouts were due to dipshits. I mean, it talks about, in the article here, it talks about people, catering to the richer clients and stuff. But as with any bank, the private bank, the high net worth individuals, the ultra high net worth individuals, unlike that one, which is also referencing how they all got called, that's the most profitable part of the bank. So no, it's not because of rising wealth concentration. It's because of dipshits. It's simply morons who should not have had their jobs, who managed to implode their banks. It's that simple. So typically financial crises, as in a sort that might actually do impair the banking system as a result of leverage speculation. This wasn't leverage speculation, even though I'm sure they were stupid enough to do that too with the toiletries. Is this one of those rare instances when this time might actually be different via rising wealth inequality? No, you have rising wealth inequality because for the last fucking, say, 70 years, 80 years, these people have had an inflated standard of living because at one point, up until about the 1970s, from the 1940s or maybe earlier than the 1940s, but up to the 1970s, it was a creditor nation to the world. Since the 1970s, since they defaulted, that is no longer the case. It is now the largest debtor nation in the history of the world. And it simply prints money to inflate the standard of living of the people in it, which, the world is no longer going to do, especially after this. So, they like to cry about rising wealth inequality. That's why. Because now it's going to the market clearing price of what these people are worth, what this human capital is worth. And as diluted as they are, they don't like to accept that fact, but the vast majority of them, who again have no exceptional talents, have no skills, have no education, have no background. These are the people that simply thought that they would have a first world standard of living if they just showed up to work. That's all they had to do. Show up to work and do whatever menial task and then go home at 5 p.m. That's no longer the case. Absolutely not. And it's only because, again, they were subsidized by the entire rest of the world. So that's why they have their wealth inequality, creating new levels of hot money that can slosh in and out of banks, making many of them fundamentally less stable. Well, in this case, it's not rising wealth inequality that did it. It's dipshits who made the bank insolvent. And so people who were the biggest account holders, the ones with millions of dollars in there, companies or not, companies or private individuals, like Roku with $500 million, if they weren't idiots, they would have gotten that money out of that bank immediately. And these days, transfers happen pretty quickly, unless you're in SWIFT, which is an antiquated system from the 1970s. So, again, you can see, just like this, you can see exactly what I'm talking about. Basically degenerates. They're fat, stupid, lazy, and entitled. And instead of fixing their own problems, they bring attention to that fact. Namely, improving their lot in life, making themselves more valuable, versus thinking that, simply they're entitled to a first world standard of living and that the entire rest of the world should pay for it. But now, admittedly, the continued rise in wealth inequality is an effect of sustained low central bank interest rates. No. Well, in a sense, yes, right? They get poorer because the only people who benefit from low central bank interest rates are the ones who have access to that printed money, tons of capital. The rest of them are screwed. So yes, that's an effect of it. But again, it's also ending their standard of living because, well, that central bank can no longer print money. Not with the rest of the world buying it up and lending them that money to have them have their inflated standard of living, which is why all of these banks are imploding. That's exactly why. Which goosed asset prices generally. Oh, and you'll have to excuse me, by the way. The money changers are still telling people to drug the reverend here. But yeah, you have to excuse me if I'm speaking oddly. Which goosed asset prices generally, for and inflated asset prices for people who had access to the capital and who could buy stuff with it. That's it. And particularly favors speculative plays as investors reach for returns. Well, there's a lot of cheap money, and not just cheap money, it's negative interest rate money. So to earn a yield on the money, you have to take more leverage and riskier position. That's what the central bank created. A great deal of commentary has correctly focused on the effects of deflating these asset bubbles and how the rollback of paper wealth can be particularly harmful to financial firms that wrong-footed the correction. Again, that's a little bit of an understatement. There were a lot of dipshits who did the dipshit trade solely because it's done by convention. None of them bothered thinking, and that's why you have the global financial system collapse. And deflating these asset bubbles. Well, there's two parts to that, right? These shit banks are now insolvent because they're sitting on commercial real estate, on backed securities, and those are worthless. Those are worthless for other reasons, including the rates rising. But yes, the other assets such as real estate, what else is there? You even have retarded things like NFTs, all of this shit. When there's less cheap money being thrown at it, money gets more expensive with higher rates, then the asset bubbles deflate. But that's not the reason why the banks imploded, because the banks are insolvent, because they were dipshits, because they for some reason could not foresee, even though it should have been glaringly obvious, that those plain vanilla trades to U.S. toiletries would be worthless, or well on their way to being worthless. But the reduction in wealth also produces a system-wide reduction in liquidity. It's not a problem with liquidity. The liquidity from the bank is gone because all of the depositors withdrew their money because they found out it was insolvent, which should be the case for every bank that's insolvent. And as I saw in the money changers that drove the reference food here. As I had seen in another article, that there are at least 180-something banks, 186 banks, I would guess much more than that are insolvent. So if you're depositing your money in these institutions, you would be a complete dipshit to keep your money in these institutions. It's not a system-wide reduction in liquidity. mean, they raised interest rates, they did a little bit of QT, but there's still a shitload of money floating around in the monetary system there. So it wasn't a system-wide reduction in liquidity. It was the fact that the people who managed the banks shouldn't have had their jobs. They were dipshits. And then people realized the bank is insolvent, and no sane person would keep their money in an insolvent bank, unless they wanted to learn the definition of fractional reserve banking. And again, bank runs like these happen all the time. They have happened for the entire fucking history of fractional reserve banking. Mind you, we've always thought liquidity is not the virtue that investment touts make it out to be. Rogue just got by just fine in the Stone Ages with less than instantaneous trading times and higher transaction costs. Yeah, and they also traded. It was difficult to print. More gold coins. That's not the situation you have now. The effect in a regime where, for better or worse, there are or have been lots of big fish with tons of cash who are accustomed to moving it quickly would wind up looking like an emerging market. Well, see, this is the other thing, right? Who does a bank take care of first? Their biggest clients. You walk into a bank where you have an account worth more, 100 times more than the other person, they're going to take better care of you than the other person. This is how banks work. It would be idiotic not to. But the point being, there have always been customers, huge customers in banks, and of course the banker is going to take care of them first. Even if it means moving their money out of the bank, giving them a phone call saying, hey, bank's in trouble, you have to get your money out of the bank, because they want that customer's business later, even if they're at a different bank. Yeah, and again, I use the words third world shithole. This person uses the word look like an emerging market. But yes, you are a third world shithole, and you're having bank runs like a third world shithole, because you now have debt like a third world shithole. It's only third world shitholes that print these kinds of amounts of money. And the only reason why the United States has been able to do it is because they've had the reserve currency status, which they're in the process of losing right now. People do it by convention, but as you see, this convention is now over. Especially in the form of fucking U.S. treasuries. It's like, why do we take cash? Because we always have. Why do you take U.S. treasuries? Because we always have. Not anymore. It's over. So, again, they're well on their way of losing their reserve currency status, and it should be the case. After printing trillions of dollars, what did you think would happen? Oh, and then pissing off your biggest creditors. Jeez. Where U.S. interest rate moves wind up producing huge and destabilizing waves of hot money moving in and out. It appears not to have occurred to the authorities that we are restructuring our financial system so as to make it possible to generate banana republic levels of upheaval. You are a banana republic. That's why you're having banana republic financial system problems. You don't produce anything. All of your manufactured goods come from overseas, namely China. And they are the ones who loan you trillions of dollars to buy those items. You do not even produce anything, any wealth creation or anything, any GDP. You just have printed money. And now, inflation. You don't produce anything. Arguably the only thing they produce is cultural degeneracy in the form of Hollywood that they export to the world, who, again, do not have a monopoly on that either, because, well, there's much better stuff that you can find out there. Just like, well, why do people watch this instead of Bloomberg, right? It's better than Bloomberg. There are much better commentators that I can find on the internet than I can find on, these, financial pundit, shit stations. CNBC, Bloomberg, Fox Business. I don't know if there was a Reuters TV or something, but the point being that the only thing that they do manufacture is crap. You are a banana republic. Oh, and in fact, you can't even grow bananas. So you're pretty screwed. And the food you do grow is some of the lowest grade shit on earth. They even ban in places like the EU. So you're a little bit worse than a banana republic, actually. Not to mention the people you brought into the country are fucking people from banana republics. I mean, a quarter, at least, no, probably a third of the country are people from banana republics. And then somehow you're shocked it turned into a banana republic. The great crash blew back to the banking system because stock buyers were making heavy use of margin loans, and on top of that, stock operators were creating leverage structures, trusts of trusts of trusts. Contrast, I'm guessing that's 1929 that there was. By contrast, the 1987 crash, the result of leverage buyouts producing a stock market bubble, didn't do lasting damage, and neither did the later leverage buyout collapse and large-scale workouts on leverage buyout loans. The big reason is that the loans were syndicated in big foreign banks with big buyers that didn't eat enough of this bad U.S. cooking to get really sick. That again is pretty funny because this time around they managed to crash the global financial system because the entire world buys the toiletries garbage by convention, especially Japan. And now they're going to collapse too. Their financial system will collapse too. Like I said, I don't understand how all those bank indices haven't gone to zero yet, or at least limit down. But it's probably because of intervention or opium, and it's well on its way there. You just get a little volatility on the way down. The Japanese financial crisis was the result of a dual commercial real estate and stock market crash. Well, kind of what you're getting now. Together on a scale that has stalled Japanese growth for decades. You haven't had any fucking growth. You didn't have any real growth. You're in contraction for the last, since 2008. They haven't recovered. They just try to paper over it. And they cause inflations in certain asset classes. And, now it's all coming to an end. The 2008 crisis looks like a housing crisis, but the severity of the damage resulted from credit default swaps creating synthetic subprime debt that was 4 to 6 times real economy exposures. Here. 2008 crisis looks like a housing crisis, but the severity of the damage resulted from CDSs creating synthetic subprime debt that was 4 to 6 times real economy exposures. And again, we've already exceeded 2008 levels of bailouts from the Fed. And it is not some exotic derivatives that have caused it. It is that there are dipshits who screwed up one of the most common trades that banks make. In fact, the bank should only be... This should have been one of the simplest things done by the bank, and they managed to screw it up, or all of these banks. This is a long-winded way of saying that herd behavior in bad lending and or leverage speculation produced enough in the way of actual or soon-to-be-realized losses to damage a lot of banks. No. Again, it wasn't herd behavior or bad lending in this case, I mean. It was the fact that the banks didn't do the one simple task that they had. And I think it touches on that later on, where it only has to manage long-term fucking liabilities and make money with short-term fucking debt. Or your short-term, mitigation. It only manages the short-term liabilities, the long-term deposits. And it wasn't herd behavior. It was the fact that they just do things by convention. They didn't bother fucking thinking. And now all those banks are going under. And banks are interconnected. If one bank gets in trouble, this is true to an extent in this one, but it isn't the interconnection of the banks that caused the problem this time. It was the fact that a lot of these banks were run by people who should not be running those banks. It's that fucking simple. And yes, they are interconnected, and then you're going to see the bigger banks blow up because of the derivatives. And just like you saw with the SVB, it's interconnected to other things, like all the things that are their customers and can no longer pay their payroll. That is the interconnectedness there. But, the term's contagion, misleading in this case. It's not that, hey, like Lehman had a bunch of swabs with somebody else, and then there's the counterparty risk. It's the fact that these banks were dipshits. They screwed up the simple task that they have, and then now the big banks are going to go under because the counterparties on those trades are going to have to pay for those screw-ups if they were hedged. If those linked customers of other banks have an unexpected hit to income, they can default on their debt payments, probably getting damage across the system. That's true too, but in this case, it's the simple fact that they're insolvent. And they're insolvent because they screwed up the one simple task that they had, which was managing interest rate risk, or in this case, treasuries, and why you should not have thought that they were risk-free. And the crisis of the past week was not that. 3 different banks with very different business strategies and asset mixes got in trouble at the same time. Again, and they all did the same thing. They screwed up with the dipshit trade. This is why they went under. They're not interconnected like Lehman, Bear, and what's the other one? Lehman, Bear, what's the other one? Chris, medication. But they went under because they all did the dipshit trade. Some like Barney Frank on the board of Signature Bank argue that the common element was a regulatory crackdown on banks too cozy with the crypto industry. No, that's not it. Crypto is just one of their clients. Shitcoins, by the way, they shouldn't be calling it crypto. Shitcoins. But that's not really the case with SBB, which has been suffering for a while from declines in its deposits due to a fall off in refunding across the tech line. Okay, so maybe their deposits went down because of that. But their bank is fucking insolvent because their fucking capital reserves, they screwed up buying toiletries. That's why Silicon Valley Bank failed. She's been suffering for a while from declines in funding, as well as more difficult business. And again, they're not the only one. There are several hundred banks in the U.S. alone, as well as more difficult business conditions leading to not much in the way of new customers and falls in deposit balances of most existing customers. What the 3 banks did have in common was a very high level of uninsured deposits. which made them particularly vulnerable to runs. No, that's not what made them vulnerable to runs. The fact that they were fucking insolvent is what made them vulnerable to runs. Because they pulled off the dipshit trade. And of course, if your deposit is uninsured, even if it was, you wouldn't keep your money in an insolvent bank, with the whole purpose of your deposit being a demand deposit. And therefore should have led the bank's managements to be very mindful of asset liability mismatches and liquidity. And they should have focused on fees rather than a balance sheet to achieve better profits. Silicon Valley Bank has attempted to wrap itself in the mantle of being a stalwart of those rent-extracting, innovative tech companies, but Silicon Valley Bank is hiding behind the skirts of venture capital firms. They are the ones who provided and that kept organizing the influx of capital to these companies. The story of the life of a venture capital-backed business is multiple rounds of equity funding. Borrowing is rarely a rarely significant source of capital. So the idea that Silicon Valley Bank was a lender to portfolio companies is greatly exaggerated. Both the press and several readers have confirmed that the reason for Silicon Valley Bank's lock on the banking business of venture capital funding companies was that the VCs required that the companies keep their deposits there. And that's because the VCs could keep much tighter tabs on their investee companies by having the bank monitor fund in and outflows on a more active basis than the VCs could via periodic management and financial reports. Again, this doesn't matter. This isn't why all the other banks are fucking failing. The banks are failing because their capital reserves are worth nothing. That's why they're failing, because they're insolvent, and nobody in their right mind will keep their money there. Now, what flows from that? One of the basic rules of business is that it is vastly cheaper to keep customers than to find them. Silicon Valley Bank, which again, private bank, people will care much more about the bigger depositors, the bigger clients than the smaller ones. People like JP Morgan even charge smaller depositors an interest rate to be providing their services, a fee for providing their services, which is like a negative interest rate, because they don't want to deal with smaller clients. It's just not worth it. Silicon Valley Bank would be highly motivated to attract and retain both the fund and the personal business of its venture capital kingpins. Accordingly, the press has pointed out that loans to vineyards and venture capital honchos' mortgages were important businesses. It's not hard to think that these were done on preferential terms to members of the big VC firm's family as a loyalty bonus source. These are all relevant. Top of that, recall that Silicon Valley Bank bought Boston Private with over $10 billion in assets. In July 2021, the wealth management firm also had a very strong registered investment advisor platform and additional asset management. Again, that the bigger clients matter. Obviously, the people who don't have any wealth to manage aren't going to be in the wealth management side of a private bank. So, that, of course, is what they care the most about. The people who bring money to the bank. It suggests Silicon Valley recognized increasingly that the care and feeding of its rich individual clients was core to strategy. Again, this has been the case for the entire history of banking. So, you don't really care about the other ones because they don't bring money to you. It's impossible to prove at this juncture, but I strongly suspect that the individual account withdrawals were at least as important to Silicon Valley's demise as anything. No, again, they were dipshits. They were affirmative action dipshits. So they failed. And the bank did not have any reserves. The bank did not have any reserves, so nobody in their right mind would keep deposits in there. And again, there's more of your nouveau poor. Their standard of living will be gone, and their retirements are gone now, pretty much. Because, again, who runs these 401ks and these pension funds? Dipshits usually. And you would have seen some of them got hosed on the credits. We're going to do a video on the Credit Suisse bailout. I guess takeover by UBS, technically, but it's still a bailout. And you can see all the pension funds that got hosed on it. So, again, they're generally people that shouldn't have their jobs. But search engine gander quickly shows that it is recommended practice for companies to keep their payroll funds in a bank account separate from that of operating funds. One has to assume that the venture capital overlords would have their portfolio companies adhere to these practices. Again, if you pick that up pick up that audio, the whole dipshit trade was done basically on the same premise on the way those people think. Like you hear them in their idiocy thinking they're smart with their pseudoscience. Yet they're the ones desperately spying on me because they have no idea what the fuck is going on in the world. And they think they're the ones that are sane, when, just like I said, their fucking pensions are gone, their retirements are gone, and a lot of them will be in poverty. Millions of them. So, again, they just think some bullshit. They think this is the way it should be. They can't explain why they think it. And that's why they're in the situation they're in now, which is a complete and utter collapse of the banking system in the United States. Well, the world too, but as it pertains to these idiots in the banana republic that is the United States. Which, like I'd said in other, videos, because I do know how much of a shithole it is, there is no way in hell I would ever be the president of this fucking dump. But if you're a complete ignoramus, you think it's the greatest thing on earth. And that's what you have. Ignoramuses. Just like the dipshits who did the dipshit trade, and now you no longer have a banking system. The press also had anecdata about wealthy customers in Boston getting so rowdy when trying to get their money out. The bank called the police as per Peter Deal to the tune of $50 million, Oprah, and the butters, as serious depositors. And again, with the banks insolvent, you're not going to be the dipshit that gets your money out last. Otherwise, you get to learn about fractional reserve banking. Similarly, there is evidence that the run at Signature Bank was that of rich people. Of course. I mean, they generally should not be dipshits, otherwise they wouldn't be retaining that wealth, would they? But when there's a bank that's insolvent, the people who have the most money in the bank will probably be the most concerned. Lambert presented this tidbit from the Wall Street Journal yesterday in water cooler. A rush by New York City real estate investors to yank money out of Signature Bank last week played a significant role in the bank's collapse, according to building owners and state regulators. The withdrawals gained momentum as talk circulated about the exposure Signature had to cryptocurrency firms, and that its fate might follow the same path as Silicon Valley Bank, which suffered a run on the bank last week before collapsing and forcing the government to step in. Word that landlords were withdrawing cash spread rapidly in the close-knit community of New York's real estate families, prompting others to follow suit. Regulators closed Signature Bank on Sunday in one of the biggest bank failures in U.S. history. Real estate investor Marks Realty was among the many New York firms to cash out and drawing several $1 million in early last week from Signature accounts tied to an office building, set off Chief Executive Craig Devlin. The section also illustrates a point that makes it hard to analyze these bank crashes well. The very wealthy regularly use corporate entities for personal investments. This is not new. So looking at corporate versus purely individual account holdings is often misleading in terms of who is holding the strings. Business owned by a billionaire does not operate like a similar sized company with typical corporate governance. Yeah, and again, wealthy people don't collect a paycheck like a 9-to-5er. So, yes, and this is, again, it wasn't that wealthy people took out their money because they're not dipshits. It's the fact that dipshits destroyed the bank and wealthy people had to move their money. Ironically, First Republic Bank, who holds itself out as primarily a private bank, had the lowest level of uninsured deposits, 67% versus 86% at Silicon Valley Bank, 89% at Signature. So again, it doesn't matter if they were large depositors that were the ones moving their money. Nobody's going to keep their money in an insolvent bank, which, judging from what I saw, especially with that article saying there's another 200 banks to go under because they're insolvent, you would be a complete and utter dipshit to keep your money there. But its balance sheet was heavy on long-term munis, which were not eligible collateral at the discount window or the Fed's new Bank Term Funding Program facility. Hence the need for a private bailout. And again, this is the even better part. There's going to be plenty of this stuff. Some will have munis, some will have commercial real estate, some will have some other asset-backed security. Some might even have the other sovereign debt of the other stuff that are floating too, because they have to raise rates too. So, and again, look at these imbeciles who keep repeating their moronic imbecility. If you're picking up the audio there, these are imbeciles that cannot comprehend logic, reason, or facts. Especially as it pertains to this moron making references to my billion-dollar businesses. This is an imbecile. And these are the imbeciles, and it's this sort of imbecility that got you this banking crisis. Because that's how the imbecile thinks. It doesn't. It's not capable of reason. It's an imbecile. It can only repeat things. Kind of like an idiocracy. They just repeat stupid things over and over again because they're idiots. And it's not unlike what you see on the financial pundits or the CNBCs or even better on the social media, where they're just repeating the same stupid thing over and over again, and they have no idea what they're talking about, nor can they explain it well. Kind of like if you asked one of these, CFOs, why in the hell does your bank have U.S. treasuries when you just shut down the entire world for 3 years and printed how many trillions of dollars? And they won't be able to explain it. All they'll say is what's said by convention. Oh, this is what we were supposed to do. This is what the textbook says. Blah, blah, blah. They're not able to reason. They're not able to think. And that's why they're in the situation they're in. Namely, you no longer have a banking sector. Not you. But its balance sheet was. Oh, and if you pick that up too, it even had the accent in the movie Idiocracy, which is amazing. The level of stupidity. Before you say, well, if there was even time to figure out how to backstop payrolls, which there wasn't, we had to go whole hog because of contagion. Again, it's not contagion. There is some contagion. There will be, when the derivatives blow up with the bigger banks. But as it pertains to these three banks that this person is talking about, the problem was not contagion. They were isolated from their own failures amongst these three banks. These are mutually exclusive. And the only thing common between them is that they pulled off the dipshit trade, done by convention, without bothering to think about it. So, that is not a satisfactory answer, because nearly all banks have sizable treasury and or agency holdings. That's the key part there. Because nearly all banks have sizable treasury and or agency holdings. Because nearly all banks have sizable treasury holdings. The dipshit trade. And now you no longer have a banking system. The new Fed interventions come very close to being a full backstop of uninsured deposits. Which again, the deposits are insured, supposedly, but they're writing checks they can't cash. And it doesn't change the fact that these 200 banks they've found so far are insolvent. And As you see there, that's probably not an exaggeration, because nearly all banks have sizable toiletry holdings because it's done by convention. It wasn't gambling. They were just being dipshits. The answer to that is basically, because this is what we've always done. Well, you shouldn't have done it in this case. Or even better, this is what the book says. This is what the experts say, with the other stuff. Well, no expert would have told you this in this case. This means vastly more subsidized gambling. And again, it might be gambling, but it wasn't gambling that imploded all these banks. Dipshits. There should be a great increase in supervision and regulation to try to prevent more sudden meltdowns. What are you going to supervise? This isn't the regulator's fault. This isn't. It's not, any of these regulatory bodies' fault that these morons running these banks were fucking morons. I mean, it's not their fault. And it should have been seen, miles away. This isn't a sudden meltdown. Which one would expect to become more frequent otherwise due to even greater government backstop? No, it's only going to be more frequent as more people figure out they have that holy shit moment when they figure out that all of these banks have all of these toiletries as their reserves, or a huge part of it. Huge. Or some other garbage like commercial real estate, or in this case, garbage munis too, by the way. And they're going to be insolvent. That's the key part. That's the only part that matters. And no government backstopping will print trillions of dollars for the deposits in these banks. They can't. And even if they fucking did, even if they did, guess what? Then you have inflation, and you're pouring fuel on the fire. As Georgetown law professor Adam Levitin put it, the by the fucking pivot bears some consideration. No one in the private market would lend against securities at face rather than the market. But that's what the Fed's doing in order to enable banks that have held to maturity securities avoid loss realization. And again, this whole held to maturity concept is completely fucking retarded in the current inflationary and interest rate environment, not to mention geopolitical environment. It's guaranteed loss realization. You're just holding it to maturity. But you're definitely going to have a fucking loss. And your bank's insolvent. The Bank Term Funding Program is a lifeline for banks that failed at Banking 101. And that's the stuff I was saying in another video. Suppose you held all the real estate and the toxic debt that Lehman had for 15 years, since the 2008 crisis. You'd be perfectly fine. If you hold these toiletries, these garbage, asset-backed securities, or these garbage munis, or these other garbage, sovereign or whatever debt, you're going to be screwed. It'll be worth nothing. You will have guaranteed fucking losses. This is much worse than Lehman. The whole nature... Oh, and again, this is the whole point here, too. The Bank Term Funding Program is a lifeline for banks that failed at Banking 101. Managing interest rate risk. That's the important part there. That's the only part that matters, actually, in this little note. The Bank Term Funding Program is a lifeline for banks who are managed by dipshits that failed at Banking 101. Managing interest rate risk. That's it. Because these dipshits only manage a simple depository institution. Like I've said in other videos, they are not investment banks. They do not deal in any complex trades. They don't have any businesses that, are intensive or labor intensive, however you want to put it. This is a very simple task. You just manage a depository institution. That's it. You take deposits, then you use that money and you loan it out. Either you loan it out to your customers, or you loan it out to the U.S. government buying treasuries, or you loan it out to people in a commercial real estate, and those debt products. Real fucking simple. Should be fucking run on autopilot, actually. But all of these dipshits manage to make their banks insolvent because they're dipshits. That's it. The whole nature of banking is that it involves balancing long-term assets and short-term liabilities. Yeah, that's what I was trying to say. That's the medication. But firms that can't do that well probably shouldn't be in the banking business. And again, that's what they screwed up. And now they will no longer be in the banking business because they're dipshits. It's over for their banks. 200 of them, actually. Just in, the United States alone. All over the world, thousands. I mean, they're gone. Yeah, like I said, they would have been better off if they were Lehman. And then it's another video that we've been making of people talking about the European ones that were already teetering on the edge. Moreover, European banking regulators regularly been criticized for last-minute kick-the-can interventions or finding out how the U.S. rules-based order, if we get to rewrite the rules when we feel like it works in their arena. Well, then again, this is laughable because, again, the U.S. is well on their way of losing currency reserve status, which, again, is highly, highly underpinned by the U.S. toiletries. The only reason the U.S. has the currency reserve status is because it made a deal with the Saudis to offer it military protection while taking U.S. dollars as payment for oil, which then became, convention for payment in oil, like OPEC, for example, which isn't the case anymore either. But those dollars would then be used to buy U.S. toiletries. Now, nobody in their right effing mind, including the Saudis, will be doing that. So, your U.S. dollar reserve currency status that allowed it to print money is gone. It's over. And like I said, these people will be poorer than Mexicans in only a few years. So, the Europeans, in that sense, will be much better off than these clowns. Moreover, European banking regulators regularly been criticized for last-minute kick-the-can interventions or finding out how the U.S. rules-based order, if we get to rewrite the rules, which again, that's no longer the case. They're not writing any more fucking rules. Europe's financial regulators are furious at the handling of SVB collapse, privately accusing U.S. authorities of tearing up a rule book for failed banks that they had helped to write. And again, that rule book was bail-ins. I think this one talks about the Cypriot banks that went under, what was that, 9 years ago now? And their rule book was to have bail-ins, that they don't bail these banks out. They have to have the depositors who are considered shareholders in the bank. They don't have deposits in the bank, they have shares in the bank. They are the ones to be, taking the losses instead of countries or central banks having to print money to pay for the bank failure. So that was supposed to be their playbook. But the U.S., who I think at this point they've figured it out, because I'm pretty sure they're having their meetings 24 hours a day at this point. But the United States initially thought, if you saw the initial reports, you would have seen, oh, these are toxic debt products. This is just a run on the bank. This is just a panic. No, this is endemic dipshittery where every bank, just about every bank, has no capital fucking reserves because they're dipshits that only did things by convention instead of actually thinking about the environment that they were in. So now their banks are insolvent, and nobody in their right mind will stick around to find out what happens with that insolvent bank. And so far, the only ones that went under were about 5 banks in the U.S. There's another 200 to go that they've found so far. So, while they might be doing something like backstopping the deposits for SVB and Signature Bank and whatever other, they won't be able to do it for all of the banks run by dipshits because there's going to be way too many of them. And even if they did, they're writing checks they can't cash by, assuring those deposits. Even if they did, they pour fuel on the fire because they're going to have to print trillions of dollars to do it because that central bank is already broke. While the disapproval has yet to be conveyed in a formal setting, some of the region's top policymakers are seething over the decision to cover all depositors at SVB, fearing it will undermine a globally agreed regime. And again, they shouldn't have bailed it out. They should have did the bail-in, what they were supposed to do, because, hey, that's if you're dumb enough to put your money in that bank, you're dumb enough to have those morons, those dipshitters, those affirmative action dipshitters, actually, well, you deserve it. You absolutely deserve it. But because these people, especially at SVB, knew some people, like the CEO was a dipshit at the San Francisco Fed, apparently. They got the deposit holders or people crying, they come from that, that, what would you call it, money changer country. There are a lot of those money changer companies in there. So, of course, they're going to cry and call on the phone and call their money changer pals. And, yeah, that's what they had happen there. But as for the rest of the hundreds of banks that they just found or have recently found, yeah, it's going to be impossible to do without the bail-ins or the haircuts or whatnot. Unless, of course, they want to pour gasoline on the fire while they're writing checks they can't cash. One senior Eurozone official described their shock at the total and utter incompetence of U.S. authorities. Again, it wasn't the total and utter incompetence of U.S. authorities. It was the total and utter incompetence of these dipshit bank managers, of these dipshit bank CFOs and COOs, and on down. It's just a simple depository institution. Any dipshit should be able to operate it, but even that they screwed up. Particularly after a decade and a half of long and boring meetings with Americans advocating an end to bailouts. There'll be a lot of fucking meetings now. Europe's supervisors are particularly irate at the U.S. decision to break with its own standard of guaranteeing only the first 250,000 of deposits by invoking a systemic risk exception. Again, this isn't systemic risk in the sense that one bank, like one of these, actually it won't be, the G-SIBs or the SIFIs, yeah, it'll be a systemic risk when it implodes, when the derivatives that are going to be directly affected by the dipshit trade implode. But as it pertains to the smaller depository institutions, the regional banks, this is not a systemic risk. It was run by dipshits, and the system was full of dipshits. That was the only problem. Despite claiming the California-based lender was too small to face rules aimed at preventing a rerun of the 2008 global financial crisis. Again, this isn't the rerun of the 2008 global financial crisis. You would have been much better off in 2008 because it was only a few banks that were dipshits. And they excusably had a trade that, people didn't know enough about. And, there was rampant fraud, underpinning it too. This one, they were just fucking dipshits. And it was almost every fucking bank. Or a lot of banks, I should put it. And like I said, if Lehman kept all those real estate properties 15 years later, they would have been fine. 15 years later, with these garbage toiletries, these garbage debt products, you're going to be in a horrible condition. So you're much worse off than the 2008 global financial crisis, because this affects many more banks too. So, yeah, this is not a rerun of 2008. This is a hell of a lot worse. So, mind you, the Europeans are not being hypocrites. They forced the unsecured depositors at a Cypriot bank to take 47.5% haircuts in its banking crisis, which, again, a massive inflation. You're going to do here, too. Admittedly, those were banks in a country seen as a money laundering haven, but it had a lot of British retirees banking there, too. Oh, and don't forget, people in America, their retirements, those are gone. Those are gone. The EU, and even if it wasn't, it'd be gone in inflation. The EU also tried to get banks to use bail-in structures like COCO's bonds. The U.S. was skeptical of them, and as we predicted, they had perverse effects. But the point is, the EU has made a much more serious attempt at renouncing bailouts than we have, even if they have yet to find the secret sauce. They are not shy about calling out who bears the cost. And again, who bears the cost? Basically the poorest and the dumbest. They're going to be bearing the brunt of it in inflation. The U.S. has claimed SVB's failure will not hit taxpayers because other banks will cover the cost of bailing out uninsured depositors, over and above what can be recouped from the lender's assets. However, a European regulator said that the claim was a joke, as U.S. banks are likely to pass the cost on to their customers. At the end of the day, this is a bailout paid for by the ordinary people, and it's a bailout of the rich venture capitalists, which is really wrong. And who had pals, because they're money changers. He said, a lot of them, So not only are the bailouts an effect of rising wealth concentration, they're going to make it worse. Nicely played. And again, it's the worst collapse in history. And it's the end, basically it's the end of their financial system. There'll be a new one to take its place. But it's the end of their financial system. And it'll be the dumbest, most useless garbage that bear the brunt of it through inflation. Again, make sure to make a donation. That's why you're in the situation you're in. If you didn't donate and didn't pay your tithe, and now your financial system has gone straight to hell.